Today on Your Money, Your Wealth, how much of your money should you keep in cash? Should you buy VBK, the Vanguard Small Cap Growth ETF? In this grab bag of an episode, we're talking about asset allocation and asset location, the pros and cons of the Roth 401k, Medicare, spousal and survivor Social Security benefits, tax-saving charitable giving, small business strategies, and who qualifies to be called Joe Anderson's peer, and whether you'd rather hang out with a James or a Jimbo. Ask your money questions and get all of today's free financial resources and the full episode transcript in the podcast show notes. Get there on your phone by clicking the link in the description of today's episode in your podcast app. On a desktop computer, visit yourmoneyyourwealth.com and click Listen to Podcasts. I'm producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
Maggie from Iowa. She writes in, Dear Andy. She's top billing.
Yeah,
here.
she is.
You guys better watch out.
Yeah. Al and Joe, I'm last billing. Thank you, Maggie. I think I'm going to skip this question.
Saving the best for last. Come
We
on
got
now.
Michael from Ohio writes in.
He's the one that called you a great one, so no wonder.
Yeah, that's why you want to do that one.
So Maggie writes, hello from Iowa. Well, hello back. Thank you for the podcast. I have learned a lot from it. My 17-year-old son listens to it as well. He's thinking about being a financial planner after college. All right, very good. That's a good career path. Question. What percentage of total net worth do you recommend to be in cash? Most of our tax advantage investments have zero cash, mostly stocks and a tiny bit of bonds. I'm just wondering if I am cash heavy or about right. Background if needed, because I've listened enough to know you sometimes need more information. All right. Well, thank you very much, Maggie, for the information.
Yeah, we got like 4 bullets here.
Okay. My self-employed husband makes $70,000 a year before self-employment taxes. We contribute $14,000 annually to our Roth IRAs. He has a retirement account through his business. Our expenses are about $55,000. I want to keep at least $30,000 for an emergency fund. His retirement account is $420,000. Roth IRAs are $200,000 and $250,000 for mine. We have college savings of $112,000 in 529 plans. $150,000 in a brokerage account, $10,000 HSA. $120,000 cash in CDs with high interest checking. High CDs 3.43 and lowest is 2.5. When I take out college savings and HSA from the equation, I figure we are about 10.7% in cash. We're 56 and I'm a stay-at-home mom. College savings is enough for my youngest son to make it through college debt-free. I look forward to your answer. All right, so Maggie's curious.
Yeah.
About her asset allocation.
How much cash is too much?
And I'm guessing she's equating CDs as cash.
I think so.
Okay. And so she's got CDs that are paying 3.5% and 2.5%. It's pretty good.
That's really good.
Right? That's a good bond.
That's like a bond. I would sort of count that as a bond. I mean, that's my first comment. Is that's a great rate. So I wouldn't even count that as cash.
Well, it is.
I know, but I wouldn't.
So you got to count it. That's her question now.
But I wouldn't for purposes of this computation. So I'm going to answer it this way, and you can chime in, Joe. So I think the first thing you want to have is your emergency fund, which you want $30,000. We recommend 6 months to a year. So that's below your spending. You know, that's about maybe 7 months of spending. So that seems fine. The second thing I would do is I would keep in cash any monies that you want to designate for something in the near term. By near term, I mean in the next, say, 3 years.
Yep.
You know, like vacations, like home improvements, like buying a motorhome, like
new car,
whatever, right? So you keep that in cash. I would invest everything else. But when I say invest everything else, the CDs are pretty high earning, so I think I would consider that an investment. That's how I look at it.
Yep. I would agree with that wholeheartedly. What I would look at, though, outside of your cash reserves of $30,000 and whatever ancillary expenses that you have, one of the things people make mistakes on is where they're keeping their CDs, right? So 56 years of age. So if you're looking to say 10% in cash, right? But your cash reserves, let's just say $50,000 or $100,000 keep in cash.
Yeah.
Right, so that's going to cover emergencies, opportunities.
Plus
it's
stuff they
going
wanna
to
do.
something, you know.
Sure.
I think with the amount of assets that they have, put $100,000 in cash, keep it in your high interest paying CDs. Okay, that are liquid. Maybe 30,000 in checking or savings, and then the rest in the CDs.
Right.
If you like these CDs that you have 10% in, be careful of where you hold them. You would rather have them in the retirement accounts. So if you have an IRA, go to the same brokerage house, or you can go to the same bank or something like that and still buy these brokerage CDs that you're purchasing, but just put it in your retirement account because it's kicking off high interest that you're not necessarily spending. You're just reinvesting it, and it's adding to your tax bill. I'd much rather see stocks or asset classes that are a little bit more volatile in the brokerage account. So they might look at it, hey, I have $400,000 in my retirement account. I have $200,000 in Roths. She's got another $250,000, so call it $400,000, $500,000, $600,000, $700,000 in retirement accounts, $200,000 in Roth, and $150,000 in a brokerage. So in your retirement account, outside of that, she's also have these other CDs and things. I would look at it to say, put the CDs and bonds in lower, appreciated assets in the retirement accounts, and keep your higher appreciated assets outside of the retirement accounts.
Yeah, I agree with that. And so just to be clear, if the $100,000 is the right number in cash, that's outside of retirement, right? That's separate from what you're talking about. But everything else should be fully invested, and CDs paying this much could be considered like a bond.
Of course.
I'm fine with that. But they do produce ordinary income, and so you'd rather have your stocks in your non-retirement account because those are subject to capital gains. That's a much better tax rate. And you don't necessarily want as many stocks in your retirement account because when you withdraw the money, it's all ordinary income anyway. So you're just being smart on where you put your assets.
Well, here's what we see is that, all right, Maggie's got a brokerage account. Let's call it $150,000. But then they start accumulating cash.
Sure.
And so what do they do with that cash accumulation is that they buy CDs. They don't put it in the brokerage account. It's like, well, how the heck did you get the brokerage account to begin with? Well, it might have been a stock option plan, or it could have been an inheritance. It could have been wherever, where we rarely see someone put like a monthly investment, a systematic investment into the brokerage account. So they build up cash, and they're like, well, what should I do with this cash? Let's just buy CDs. Versus investing it like you're doing in your brokerage account. Another reason why I think people do that is that they might have a brokerage account and they're just playing with it. They're trading stupid stocks or this is my trading account. Well, that should be separate as well, and only have like $5 in that because you're probably going to lose it. Does that make sense?
It does. Yeah, no, I agree with all that. And I think you're right. Typically, we see people do it exactly that way. They've got their safest assets that are producing ordinary income in their brokerage account, non-retirement account.
Yeah, or it's usually in a checking or savings account, right?
Yeah, right. And their highest growth stocks in their retirement account, which is so virtually all of their income is subject to ordinary income in the future based upon where they have their assets located.
Because if you think about it, you have one, let's say investment, you have $10,000 that's in stocks, and over the next 10 years, hopefully that doubles to $20,000. Right? Wouldn't you rather have that outside of a retirement account where you can have a lower tax rate on that growth?
Yeah, so it's all about keeping more what you're making, right? Not just the amount you're making, but what you keep.
Wow, that was so wise.
That was amazing, wasn't it? Seems like I've heard you say that.
Did you say that? It's not what you earn, it's what you keep?
That's what I was trying to say, but it came out funny.
Got it. We got Daryl from Ohio. I'm Daryl from Podcast 248.
Oh, okay.
Hey, yeah. Weren't we talking about Daryl and my other brother, Daryl?
Larry Daryl.
Yes.
Larry Daryl.
And he
Daryl.
actually references that.
All right.
Oh, good. Okay.
So, hey, Daryl, welcome back. You're doing a great job. Oh, thank you, Daryl. Thanks, Andy, Joe, and Al. I'm planning to put cash into a taxable account from cashing out life insurance and selling my house. I've heard that I should use funds with less taxable events like ETFs and index fund. Someone, your peer, Josh, from Heritage Wealth Planning. Daryl, I don't know who Josh is from Heritage Wealth Planning.
Yes, but he's one of your peers.
No, I don't believe so.
Maybe not.
I don't believe so. What is a peer?
Somebody that is the same level
Equal?
as you, does the same
Equal?
thing as you.
Come on.
Oh, great one.
Oh.
No one's equal to you.
There's a lot of people out there that call themselves financial advisors or financial planners, and basically they sell crappy products.
And some are, and some we would say are not.
But no, I don't know Josh from Heritage. Hopefully he's a good guy. And now I just gave Josh a huge plug. And when everyone go check him out, do business with him.
You want to say his business again?
Heritage Wealth Planning.
Oh, very good.
He suggested VBX or VBK.
VBK.
Sorry, I'm a little dyslexic. On Morningstar, it had low expense ratio and a good 15-year return. When I look at the distribution, it shows zero capital gains, but income of a little over $1 per share per year. Is that good? If not, how would one evaluate a fund for a taxable account? Is the income reported on 1099 DIV? P.S. My wife and I are both 52, and I do have 2 brothers.
Oh, he did talk. You're right, Danny.
Oh, all right. Thanks, Daryl. So, I don't know. What do you think, Al?
Well, let's see. I don't know too much. I assume that's a Vanguard fund. Is that-
VBX?
yeah, is that a good guess?
VBK.
VBK.
That's twice.
He
Anyway,
really wants it to be VBX.
I know. Well, most funds end in X for some reason.
anyway, ETFs and index funds tend to be more tax favored than, say, actively managed mutual funds. I agree with that. And so, but whether it's an ETF or an index fund, they are going to have a capital gain distribution. I mean, by definition, at year end, so you can't avoid it altogether. But there's less of that in those types of funds because the fund manager is not buying and selling and trying to time the market. So I agree with that general premise. And the income that comes to you, it is on 1099 DIV, dividend, and there's really 3 different categories. There is ordinary income, or ordinary dividend, I should say, which is the total of dividends. Of that, you have qualified dividends, which are taxed at capital gains. And then there's yet a third kind that stands on its own. That's a capital gain dividend, which shows up also on the 1099 dividend, or DIV. And that is as a result of the fund manager buying and selling positions inside the fund.
So VBK is Vanguard Small Cap Growth ETF.
Yep.
Why is he recommending just one fund? Here, you got non-qualified, you hate dividends, buy small cap growth. First of all, small cap growth is one of the worst performing asset classes that you can purchase. I would go small cap value if you wanted to go small cap because you're paying for added risk that you're not getting compensated for per academic studies, not Joe Anderson.
Yeah, now, and let me just clarify, that's based upon decades of historical research.
Correct.
That's not our opinion. That's just what history has shown us.
Correct. And then it turned into my opinion.
Yeah, which we wanted to clarify.
After you read something that you agree with, then it turns into your own opinion, I believe.
We don't have opinions on stocks.
Well, I don't have a recommendation. We can have an opinion if it's dog doo-doo. But I'm not saying I love Vanguard, but if I don't know why he would do this. So it depends on how much money that you're putting in here, Daryl. You want a globally diversified portfolio. You want to have asset classes that are outside of retirement that have a higher expected rate of return, and you want to be tax efficient. So, yes, you want to go ETFs, you want to go index funds, but you don't have to get in the weeds here by looking at, okay, what dollar they're distributing per share. If it's an ETF or an index fund, it's going to be very, very low unless it's multi-million dollars, and then you're just going to put it into one fund anyway? That doesn't make any sense.
Well, and of course, we don't know the rest of the story. Maybe there's other investments in other accounts, and who knows, right? Maybe Josh followed your advice, and he's got the more risky asset class in the non-retirement account. He's got the safer ones in the retirement account.
Josh is my peer that I don't know, that I don't really care for right now.
Yeah, but that's who Daryl is listening to.
Got it. Okay.
Yeah. Anyway.
So, but yeah, you're on the right track. You got...
I think,
and you can't look at past performance either. So here's what people do. They pick investments or they collect them. So let me look at this particular fund. Let me look at the track record of this fund. You have to look at the asset class. Do you want small cap growth or small cap value? Do you want large cap growth or large cap value? Do you want international growth or value? Emerging markets, small, mid, large. I mean, those are the asset classes. That's the broader steps that you need to take. And then you can narrow it down into what vehicle that you're going to use to provide you with that diversification given that asset class. And so, yeah, if you want small cap growth, then buy VBK, right? That's cheap. It's tax efficient, but don't start there. You know, if some guy is talking about let's analyze this mutual fund and let's open up Morningstar and blah, 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 that's all past performance. It doesn't mean anything about what's going to happen in the future. So you're saying, hey, I got a 10% rate of return over the last 15 years. That means nothing. Zero. It could lose 30% over the next 10 years. So hopefully that helps. Thanks a lot, Daryl. Tell Bob Newhart we said hello. Anna from Chattanooga, Tennessee. Can you please talk about Roth 401k advantages and disadvantages and who should use them?
Okay.
I have a 401k plan with a Roth option, but I'm currently contributing to the regular 401k. My employer matches $50. Yep, $50. Anna, maybe get a better employer. And don't know if I should start utilizing the Roth option. I have a Vanguard IRA with roughly $450,000, a Vanguard Roth with about $138,000, $78K in a TIAA account, $20,000 in the 401k, and $750 in a 457 plan that I just found out I could contribute to. I'm 49 years old, earn $60K from my job, an additional $20K from my sole proprietorship. I'm now able to max out my Vanguard Roth every year, put an additional $750 a month into the 401k and 457, and my employer puts 10% of my salary into my TIAA. TIA. I expect my taxes to go up in retirement, and my financial advisor has said that I should start doing Roth conversions, but to also keep contributing to the 401k 457 as I am now. My question, if I'm going to do a conversion, then shouldn't I also be putting the 401k money into the Roth option? Otherwise, aren't I just moving out tax-deferred money that I'm partially putting right back into another qualified account? Okay. Thanks for the question, Anna. So she wants to do Roth or the advisor's telling her to do Roth conversions.
Right.
So, but he's like, hey, keep putting the money into the 401k 457 plan pre-tax and do conversions. So she's like, well, what's the difference?
Yeah, why don't I just put it in the Roth and do less of a conversion?
I guess it all depends on how big of a conversion that the recommendation is. Mm-hmm. Because there's limits to the amount of money that you can put into the Roth 401k. But here's pros and cons. I think before the Jobs Act, we would recommend the same advice that the advisor is giving, because you could recharacterize. If you did a Roth conversion before, you could say, you know what, never mind, let's put it back into the IRA. But now it's irrevocable. So do you put $19,000 into the Roth 401k or convert $19,000? It's not going to make a difference at all. It's the same thing.
Yeah, so theoretically, and I would say that advice holds true if your income is steady and predictable. But here's when you still might want to do a Roth conversion over the Roth 401k, because let's say your income changes at some point throughout the year and you're in a higher tax bracket than you thought. If you've already put money into the Roth 401k, you can't do it. You can't undo it. It's in the Roth side. But if you wait till December to do your Roth conversion, then you have a full year history to know exactly what tax bracket you're in, so you have a little bit more certainty.
The Roth conversion versus, I mean, it depends. Let's say she wants to do a $50,000 conversion. Well, you're going to put $19,000 into the Roth 401k, and you're still going to convert $30,000.
No, I understand. It's same. I agree with that. I'm saying if you want to do $50,000 conversion, whether it's conversion or part contribution, it doesn't matter. But what if you get a $300,000 bonus?
Right.
Then you don't want to do that. You would have rather had the deductible 401k. So that's all I'm saying, is it gives you a little bit more flexibility to do the conversion, and you do that towards year end. But in her case, it sounds like she's working for the government. Probably the income is steady, so she could. It probably doesn't matter, Anna, for you, whatever you want to do.
It's easier. I'll tell you this. It's easier to do the Roth 401k because there's no transaction. You're just checking a box, and then all your contributions are going on the Roth side of it.
Yeah.
A conversion, there's a little bit of work to do.
Plus, the other good thing about the Roth 401k contribution is you're having tax withheld as you go.
Yeah, you're not going to get a tax bill in April from the conversion.
So I kind of like that part.
So I think it depends. it's the same outcome regardless.
Yeah.
So really, if you don't like the 401k plan and you have investments that you like better in an IRA, well then do the conversion.
But I think the basic answer is it doesn't matter because you end up in the same spot. But those are some pros and cons of doing one over the other.
Asset location is another thing as well, Anna. So in Roth accounts, you probably want to have, especially at age 49, you want to have more aggressive type stocks in your Roth or asset classes that will give you a higher expected rate of return. And so if your 401k plan, I don't know if you can segregate the Roth option versus the pre-tax on how those are being managed versus, like, let's say you have $100,000 in your 401k plan, $25,000 of it is Roth and $75,000 is regular pre-tax. If your 401k will allow you to say, I want the Roth portion, the 25% of the Roth portion in this particular asset class, and then the 75% in all these different asset classes, then it doesn't necessarily matter. But what we've seen is that you want to say, I want 25% of my 401k in this account or in this fund. I want 25 in this fund, 25 in this. And they're not going to separate the Roth from the pre-tax. So you really can't get that true asset location. So maybe doing a conversion might be beneficial there too.
Where you have more control over the investments. I agree with that. That's a good point.
Asset allocation and asset location are related, but they are very different. One is based on how much risk you're willing and able to take in your portfolio based on your goals and other factors, while asset location, that is what types of assets you hold in which types of accounts, may help you save a whole bunch of money in taxes. Check the podcast show notes for some resources about both, including episode 262, which was predominantly on the topic of asset allocation. I've also thrown in some more Roth 401k info as well. If you have money questions, comments, suggestions, or if you just want to see if you can make Joe cranky talking about his peers, click Ask Joe and Al on air in the podcast show notes and send us your message as a voice recording or as an email. And don't forget to click that share button and spread this nonsense far and wide.
All right, we got a letter that came in, Bill from Carlsbad. If my wife and I file a joint return, will her Medicare payment go up relative to our combined income? If so, will her Medicare payment be relative to only her income if we filed separately? Interesting question.
Yeah,
there,
it is
Bill.
an interesting question.
So Medicare premiums are based on modified adjusted gross income.
Right.
And as you breach certain thresholds, your Medicare Part B premium increases. And it starts at...
So for a...
Do you need your glasses?
I do.
Your eyes just bugged out on me there.
Well, I'm just blinking to try to see if I can read without.
They are right next to you, you know.
I know, but it's too hard to put them on. Because I got this headphones
got
on.
it.
You know how
got
that
it.
works.
Yes.
So for this is for 2018, so we're already a year.
No, that's 2020.
Oh, that. What am I doing?
What's the Medicare premium?
The Medicare premium, the lowest one's $144.60.
And what income threshold is
Income from 2018 income, $87,000 or less for single. For married, filing joint, $174,000.
Okay. So they look back a couple of years on your income to determine what your premium is. So they'll look back to see what your 2020 premium is $164, right? But your income threshold for 2018 needed to be below
174.
You know, 174,000. So Bill's question is that his wife probably has low income, Bill has high income, or vice versa. But since he's worried about her premium, he's thinking, hey, is this based on if her income, W-2 wages, let's say, is $20,000 and mine is $600,000, my premium would be a lot higher than hers, so she would be at a low threshold. Bill would be at a high threshold. How about if we just file separately? Would that give her the lower Medicare premium payment moving forward?
Yeah, it's a great question. What's the answer?
I would say no.
I don't know 100%. And the reason I don't know 100% is because every table I ever see has single and married filing joint. We don't have a Married
I
filing
mean, the
separate.
IRS would look at that and say, no way.
Yeah.
It's just like, they don't care for merely filing separately for Roth contributions.
For almost everything.
For almost everything.
Yeah, I would agree with you. It's just that we don't know that 100%.
Right. We need to fact check that.
Yeah, we do. We do. So we think probably married filing joint is the best way to go.
Well, I think unless you get a divorce,
Sure.
then you file single.
Then you could go single.
But
yeah.
if you file separately, I'm going to say no, Bill.
I'm going to say no too, but we're not 100% sure.
All right.
Andy can check for us.
Alan's going to do some research on that, and then he'll give it to Andy, and she will send that to you.
Yep.
I can do that.
We got Tim writes in once again from San Diego. So I think he had a question on spousal benefits or survivor benefits or something like that.
Spousal benefits.
Spousal
yeah.
benefits.
Okay, and we answered that.
We answered the question.
And-
Andy sends like a long love letter and the response of us.
Yes, right.
So
A long love
so
letter.
all these questions that we answer, you get a nice letter from Andy with our response. And so Tim got his, and then he's like, thank you, I appreciate the response. And then I now know that my spouse will get 50% of what I would receive if I took it at my age 66, even though my amount goes up 8% each year after I turn 66. So he was thinking, hey, if I'm going to wait till age 70, have my wife claim the spousal benefit at her full retirement age, what number does she get?
Right.
Does she get my increased number because I waited? And we said, sorry, Tim, no, she gets 50% of your full retirement age benefit.
That is correct, and it's adjusted for inflation. Right.
Right.
So, but yeah, that's essentially right. What your 66 age benefit, your spouse would get half of that. That's the spousal
No
benefit.
matter when Tim claims his benefit. It's going to matter when his wife claims the benefit,
True.
but she has to wait till full retirement age.
Yeah, she could claim it earlier, but then she has a reduced amount.
You got it. All right, so then he writes in, I don't know if this is the correct form to ask, but it occurred to me as I was calculating the estimated amount we would get. If something were to happen to me, would her benefit jump up to 50% of the higher amount I was getting or stay at the already 50% amount I would receive at my age 66? So what he's saying now is that, okay, I'm waiting to age 70 to get that 8% delayed retirement credit.
Right.
And so my wife claims the benefit. She's getting 50% of my full retirement age benefit. She doesn't get 50% of my increased benefit. So he goes, if I die, what does she get now? Does she get 50% of the higher amount? And the answer, Tim, is a lot better than that. She gets the full amount of the higher benefit.
Yeah, she gets your benefit.
She
Your
gets
age 70 benefit.
Yes.
Yes.
Yeah. Cool.
So it pays to wait. So Tim was like, at first he was probably upset.
Right.
He's like, you know what? I waited. No, probably wasn't upset, but was like, okay, I waited to age 70 because I thought my wife was going to get a higher spousal benefit. So now I have a lot higher benefit. I waited to 70. I was thinking my wife would get a higher benefit too. But then he's like, okay, it is what it is. Then he's calculating some morbid stuff. It was like, if I die, well, maybe then it increases to 50% of the higher amount. And the answer, Tim, is no, she gets your benefit.
So that's a different kind of benefit, Tim. That's called a survivor benefit, calculated completely differently. So that's your benefit that you had or her benefit, whichever is higher. That's what she gets. But we get this question sometimes, Joe. Let's say husband or wife is waiting to age 70 so that the survivor gets a higher benefit. But what if they pass away at age 68 before they even take the benefit? Did I stop you?
No, because I was reading the next question
Oh.
because it was on a 529.
So in other words, he wasn't listening to you. Al.
I was totally not listening.
So ask him the question
Well,
again.
All right, so 68. So if he waited to 68 or it didn't take the benefit at 68?
He didn't. Yeah, correct. He didn't take it at 66 because he wanted to wait till
So
70.
he
but he
dies
passed,
at 68.
Passed away
So
at
what's his
68.
spousal benefit? Or the survivor benefit would be his age. They would make it that he claimed at the age that he died.
Yeah, that's exactly right. I think people need to know that. So, in other words, in that example, it's not the full retirement benefit. It's the benefit with 8% added for a couple more years, right? So they basically assume that it was basically claimed at time of death.
You got it. All right. Susan was on yourmoneyyourwealth.com. She wrote in. She's from North County, San Diego. She goes, my husband, 69, and I, 63, have a disagreement on spousal Social Security benefits. he is still working and will take Social Security until he's 70. Okay, so he's going to hold off till 70, Al.
Okay.
I don't have earned income. He says that I could claim 50% of his increased benefit when he starts taking Social Security at 70 and I reach my full retirement age. Well, I'm under the impression that I would get 50% of the benefits he would have received at his full retirement age, not the increased amount he will receive at 70. I have been receiving survivor benefits since age 60, like most wives. I like to be right. I went to one of your guys' 2-night classes and listened to as many podcasts as I can. You guys are informative and entertaining. Thank you very much. Well, Susan, you are absolutely correct. You will get 50% benefit of his full retirement age, not his increased benefit. So, yes, you are right. Your husband is wrong.
And it's his full retirement age benefit, 50% of that indexed for inflation.
Right.
So it could be slightly higher amount than he had at 66.
Question.
But this is weird, too.
She's
like,
receiving survivor benefits, though. How
Well-
does that change things?
well, he's alive.
So this,
Yeah, so previous husband.
Yeah.
yes.
But when I read that, she's like, I'm receiving survivor benefits since age 60, like most wives.
No, there's a period there, Joe.
I know. I was like,
And you didn't read it, and I was going, wait a minute, what?
Most wives get survivor benefits.
yeah,
at
I was
60.
like, well, who do you hang out with, Susan? I mean, there's like a string of murders up in North County, San Diego
that's-
from old men, right?
that does
Just to claim some
that
survivor
does
benefits.
read differently when you forget the period.
Yeah. Or maybe, they like to hang out at, some older places, find their husbands, and they die, and they get their survivor benefits.
Okay.
That's a strategy.
Yeah.
Yeah. So what? She's taking an ex-spouse's or a deceased spouse survivor benefit. Yeah. And so this gets a little complicated, and I don't have that much time. But when she turns to her full retirement age, she can switch to the spousal benefit, which would be 50% of her current husband's benefit. But I would imagine that the survivor benefit would probably be higher than 50%.
So can she stay with that?
Yeah.
Okay.
But
Yeah.
she remarried, so she must have remarried after her age 60.
Yeah, that's what I'm guessing too.
Because before, if you remarried, you didn't get the survivor benefit, but then people didn't want people living in sin. So they said, get married, it's okay, and you can still have the survivor benefit of a deceased spouse. So hopefully that works, Susan. Yeah, you're a lot smarter than your husband because you went to my 2-day class and you listened to this podcast, just like everyone else is a lot smarter. We got James writes in from Vegas, Las Vegas. So it's James for Al, Jimbo for Joe.
He's because you're younger.
So you're proper, and I like to call people
Yeah.
Jimbo.
Right.
I love Jimbo.
Yeah, I should start calling you Joey.
All right.
That went over like a lead balloon.
Which means I'll start doing it.
But yeah, I would party with Jimbo in Vegas.
Yeah.
Where are you going this weekend? Oh, where do you think? I'm going to hang out with Jimbo.
Yeah, and I would
Las
party.
Vegas.
I would party with James.
Yeah.
You guys had split
Yeah.
a beer.
Yeah,
Yeah.
we'd have to split our time
No.
because if we were together, we wouldn't know what to call him.
Yeah. You and James would be going to like the Hoover Dam. Jimbo and I would be going to some strip clubs.
I was not even going to ask, but now I know. We're going to go to a museum.
Yes.
That-
And I'm going to go to the casino.
Yeah.
All right. Hi, Joe, Big Al, and team. Love your podcast. Found them late last year. All right, cool. Thank you for your efforts and your service. I live in Las Vegas, Nevada. I will retire from local government in 4 years. We, my best half and I, will retire in 2024. We then will draw a pension of $100,000 a year. Wow, Jimbo.
That's great.
We have saved $950,000 in our 457 pre-tax plan, and we have $250,000 each in IRAs. All right, and another $200,000 in a non-qualified or trading account is what Jimbo calls it. Best half,
Yeah.
his wife, Jimbette.
Jimbo.
Jimbo's wife is
All right, I should say James.
Jill, or what? Okay. Best half does not have earned income for the last 30 years. We have maxed out all savings for retirement each year. Starting this year, I will only make Roth contributions for $26K at work and $14K total for wife and I. I have $8,000 in an HSA. Our before tax income is $138,000. We will get hammered by tax at 72 for RMDs. We will start converting IRAs to Roth in 2019. Plan is to go to the top of the 22% tax bracket each year with $25,000 to $50,000 conversion to Roth. These accounts have been set up at Schwab. Best half will get $200 a month in Social Security benefit at full retirement age 67. I will be earned a benefit of $1,400, but he gets the windfall elimination because of his big pension, and will get $800 at full retirement age. Okay, so I like your plan so far, Jimbo. He's got, let's see, $1.5 million roughly in retirement accounts. He's going to have $100,000 a year in pension. He's got another $200,000 outside. He's going to still contribute for another couple years, totally into the Roth, so he doesn't have to worry about required minimum distributions at age 72. He's going to have a little bit lower Social Security benefit, about $800 a month at full retirement age. His wife will get half of that, roughly about $400,000 a month.
$400 a month.
Yeah, for what did I say, $400,000?
Yeah.
Yeah.
That'd be a heck of a Social Security benefit.
Jimbo's got the in at Social Security.
He's worked for government for
Yeah,
years.
he wrote a letter and said, my wife needs to get $400,000 a year from Social Security. All right, so Social Security plan. Here's his plan now.
All right.
Best half is now 58. I'm 56. Best half claims benefit at 62 for $150 per month. This goes to fund to pay taxes on Roth conversion. I file at 65 for a benefit of $700 a month. Okay? Fund tax bill. Best half then files at 67 for half my benefit, which should be $700 a month. Assuming she can get half of the pre-windfall cut amount, and I have to file before she can collect on my record. Do not need survivor benefit. She will get the $100,000 pension when I cash out. I like how he says that. I mean, he's from Vegas for sure.
Right.
You know, here, let me color out.
There's lots. I haven't heard that. That's a good way to say it, though.
That means death.
Yes.
I think this is the best way to maximize that total payments, both combined. We use the money to fund Roth conversions to complete. What did I miss? Cost of living today is $50K per year. No payments now. We'll move to Wyoming for lower cost and taxes by 15% retirement. Thank you, Jimbo. Jimbo, I love the plan. I love the fact you're taking care of Mrs. Jimbo when you cash out, but you're missing something in your calculation in Social Security. Did you see the problem in his thought process, Alan?
I think so, but you're going to explain it better than me.
All right, so what Jim is thinking is that, all right, wife is going to claim right away at 62, and then he's going to claim at full retirement age, and then she's going to switch to the spousal benefit once he claims at full retirement age, because you can't file a spousal benefit unless the spouse is claiming their benefit.
Correct.
And so he's like, yeah, she'll get a little bit, and then once I turn my benefit on, she'll switch to the spousal. It doesn't work that way, Jimbo. My apologies. Is that it's something that's called a deemed benefit. Once your wife claims her benefit, right, it's going to be a reduced benefit because she claimed it at age 62. Once you do claim your benefit at age 67, she will receive a spousal benefit, but it's not going to be the full 50% of the benefit. It's going to be reduced because she's already taken a reduction in the overall benefit.
So she would have had to wait until full retirement age to not have a reduction.
You got it. She would have had to wait until her full retirement age to claim the spousal benefit to get half the benefit. I know you're not talking about a lot of money here because there's the windfall elimination because it reduces the benefit quite a bit because of your large pension. But you're saying, hey, you know what? I'm going to get a couple $100. It's going to help to pay my taxes. So let's have her claim as soon as possible. Have a couple of extra bucks. You'll pay some taxes on conversions. I'll claim mine, and we'll get this tax strategy dialed in with the help of the government to help pay that tax bill. It's not going to be as slick as you think. So if she does claim at 62, that's great. You'll have those couple extra bucks, but she's not going to get the full spousal benefit because she's already claimed the benefit.
Now, what about this? So she could start claiming at her full retirement age, and then when he does start claiming, then at that point, then
Correct.
Then she could switch. In other words, when he gets to his full retirement age, starts claiming the benefits, then she can switch to the higher amount, and then basically she got 2 years of free payments.
Sure.
Yeah.
So just be careful with that. There's a lot of times there's a lot of strategies or trying to game the system. I would say over the last 10 years, the Social Security Administration has kind of closed a lot of the loopholes and changed things.
Haven't they? Yeah.
So I like the thought process, but in this case, it's just not going to get you, I guess, the biggest bang for your buck as you thought. So hopefully we can still party in Vegas, though, Jimbo.
Or Wyoming when they move there.
I would rather go to Vegas.
Is that right? Well, you could ride probably horseback riding. Probably.
Oh, sure.
Cheyenne.
You could do that with a James.
Yeah.
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 Yeah. Well, you go horseback riding with James.
And I
you
know
go
where you're
partying
going.
with Jimbo. All right.
Whether you want to go to museums or go horseback riding, or if you plan to party in retirement, maximizing your Social Security benefit is important. That's going to help you pay for those retirement plans. The Social Security Handbook walks you through everything you need to know: how the benefits are calculated, the difference between collecting early and collecting late, working while taking Social Security, the rules around spousal, survivor, and divorced benefits, and the all-important taxation of your Social Security benefits. Click the link in the description of this episode in your podcast app to visit the show notes and download the Social Security Handbook. Yours free from Joe and Big Al and Your Money, Your Wealth. Oh, and by the way, for Bill and the others wondering, Medicare Part B premiums are indeed different for filing your taxes joint versus separate, and you can find out more about that in the podcast show notes as well.
We got Robert calling from Rhode Island. Hi, I'm 71 years old. I have a 401k from a company that I'm still working for. I'm wondering if I can move some of my 401k money to a traditional IRA in order to contribute to my church without being taxed. I used to take my church contributions as a deduction on my taxes, but it no longer makes sense. It no longer makes sense for Robert to itemize because of the new tax law. So he's looking to do a
qualified charitable distribution.
Yes.
QCD.
QCD. Yeah, Robert, if you're 71 years of age, so you got to be,
You have to be 70 and a half. I don't think they changed the QCD rule, just the RMD rule.
okay, but two things here, though.
Yeah.
Right? You take money out of a 401k plan into an IRA, you're going to be subject to an RMD. Since you are 71 years of age, you're going to be required to take a distribution from the IRA because you are already 71.
Yeah, that's
because
true.
now 72 is the age.
Unless you own more than 5% of the company.
Correct. But his money's in a 401k plan where he doesn't have to take an RMD.
Yeah, nevertheless, if he wants to contribute to his church, and
He wants to put the money in the IRA and do a QCD.
No, I understand.
But if the money goes into an IRA, he's going to have to take an RMD because he's over 70 and a half before he can take the QCD.
I know,
but he can use the QCD as part of his RMD.
Right. So here's all I'm suggesting is maybe he wants to give $5,000 to his church, or whatever the number is. So you do a $5,000 in-service withdrawal to the IRA, and now you got that in the IRA. Now you can do a QCD on that.
Got it.
That's what I would do.
So you would
I would you wouldn't.
You
want,
would do it all. I guess the
I would
point.
not do it all because you're right. Then you'd have to do required minimum distribution at age 72.
No, you'd have to do it at 70 and a half because he's 71 years of age.
Oh yeah, he already hit it.
Yeah,
Yeah. Look at you.
Yeah,
Right?
he's already in.
You're tight.
I know. Okay, we got a follow-up from Michael from Ohio.
Okay.
Is the blue your writing?
Yes.
So we don't have to read that again, or do we?
It's there for your reference because he actually asked a question, oh great one.
Oh, is that what he calls me?
Yes.
Okay, got it.
Only you. So I don't have to answer this one.
Except it is a tax question.
I'm going to take a coffee break.
All right. So what Michael goes, thank you for your answer, but in my case, if I had a sub S-Corp, which I could create income on paper, then I would be able to deduct contributions way past 72. I'd pay Social Security and taxes and enjoy a double contribution tax deductible for me and my wife. So Michael is committing fraud, it sounds like to me. Because in case if I had a subchapter S, so he's got a little business going on,
Sure.
which I could create income. How do you create income? Is he going to be
paper.
working, do you think?
You have your kids pay you a little
He's
bit?
creating income on paper.
Yes. Right.
So that means to me there's a little bit of hocus pocus going on.
He may not call you the great one anymore.
Well,
After this.
I'm just being honest. Hey, Joe. Oh, great one. I got this great scam. What do you think? I'm going to just make believe I'm making income. Yeah, I'll pay Social Security tax on that, whatever, but I can do a IRA contribution and take that deduction for me and my wife all day long.
Yeah. So that is...
It doesn't make any sense to do it.
Well...
Because you're paying Social Security or you're paying self-employment tax, and then you're getting a deduction on ordinary income.
Right. Yeah, so I guess maybe another way to say that, the strategy is fine. Just make sure the income's real. Don't make it up. Is that a better way to say it?
It's not as fun.
I have had this exact question before from more than one of our clients. Well, I could just, have my son pay me. It'll look like income. I'll do a Roth contribution, right?
Yeah. Well, I got this, I got the Shell LLC.
Right.
What do you think? Should I put it to work?
Yeah.
I'm like, how do you put the company to work? No, you work for the company. I got, a couple shells. Maybe we can move some stuff around. And what do you
Right.
think? Tax-wise, is that a pretty good idea? No, it's stupid. Okay. Jay from Chicago. Hi, Andy, Joe, and Al. Thanks for the very okay show. I sometimes learn something.
I agree with you.
Yeah.
It's marginal at times.
It's awful, pretty much most of the time.
Could we listen to our own show?
Absolutely not.
Yeah, that'd be tough.
I've listened to it maybe once, and I was like, wow, Andy's pretty good. Big Al's marginal, and I'm just a train wreck. I own a martial arts school in Chicago. I'm in the process of buying a house and plan to convert the 3-car garage into a gym for private lessons and small group classes. What is the tax play here? What I deduct as home office, or should I lease the space to my business and pay myself rent or something else? Interesting there, Jay. Goes, keep on the mediocre work. I kid. It's a great show. Thanks for everything.
Oh, really? It's actually better than mediocre?
Yeah. Well, this is a pretty cool question. He's kind of sophisticated there.
Yeah.
From Chi-Town. So he's got a little
Right.
martial arts. He's going to kick
Yeah.
your ass, Cobra Kai.
I know. And he's got a 3-car garage. Good for you. But he wants to convert that into a martial arts school.
I wonder what
which
his
is
wife
great.
thinks about that.
Yeah. Well, that's a
I
good
don't know if
question.
she's married or not.
Yeah,
That
we
was-
don't know.
That was assumptive.
But so what's the tax play here? So yeah, there are, I guess, a couple choices. I mean, it depends, I guess, if you have a sole proprietorship or an S corporation, for example. If it's an S corporation, then you probably want to lease it to your S corporation, and there's things you can do in terms of increasing the rent or decreasing the rents depending upon what your goals are. Right, but in terms of if it's a sole proprietorship, it doesn't really matter. You get the home office deduction or rent it to and from yourself with income and deduction cancel each other out. It's not that big a deal.
All right, Jay. Hey, thanks. We'll keep up the mediocre work.
Your Money, Your Wealth is presented by Pure Financial Advisors. Click the free assessment button at yourmoneyyourwealth.com and sign up for a free 2-meeting assessment with a certified financial planner from Pure. If you're in Southern California, we've got offices in Los Angeles, San Diego, Brea, and Irvine. And if you're outside of Southern California, your free assessment can even be done via video web meeting. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.